Good day, everyone. Thank you for joining us once again here at Seafood and Brew for our briefing. And for this briefing, we're going to go over the community bank performance for the third quarter of 2022. And for those who are just joining us, that community bank group consists of institutions with assets between $100 million and $5 billion. Overall, when we look at the growth summary, we can see we had a decent quarter in terms of asset growth, coming up 1.26% for the quarter, up above where we were last quarter in the second quarter of 69 basis points. So we had a pretty significant growth in the third quarter. This is in spite of the fact that that devaluation of the bond portfolio impacted that overall level of asset growth. We saw loan growth up 4.3%, fairly strong, little weaker than what we saw last quarter when it was at 4.85%. And we're just about done with the PPP loans rolling off. There are some loans that are still out there, but for the most part, they are gone. Deposit growth, we saw rebound a little bit, a growth of 37 basis points. In the third quarter, 86 basis points. However, we continue to see this overall level of deposit growth be anemic. And the more banks we talk to throughout the quarter, here in the fourth quarter, we begin to see that number, that deposit growth, continue to slow down. But overall, when we're looking at deposit growth for all of commercial banks, we can see we're still at about $2.7 trillion higher than where that trend line would have put us if we were to grow that deposits pre-pandemic to this point. So that growth rate is about 9 basis points per month that we saw going back 7 years. So when we capture that and we grow that trend line, we're about $2.7 trillion, continue to be in excess. Now notice at the right hand of this chart, we do see this overall level of deposits ticking down. That's showing that negative growth or that contraction of overall deposits in that commercial bank, in these commercial bank entities. So we see that come down. We haven't seen that widespread when we're looking at commercial banks solely, but we do know that we have seen the overall level of growth really trail off. This is pushing the issue of that liquidity risk at a lot of institutions where they have that loan growth, but they don't have the deposit growth to support funding those loans. And because of the investment portfolio being underwater, the need to go out to wholesale borrowings is beginning to grow. So that's just the overall level of that liquidity aspect that we're seeing inside of community banks. Overall, though, when we look at the return on average assets for the group as a whole, we can see we're up to 1.18% average return on average assets. So we're beating where we were last year at this time at 1.13 and substantially higher than where we were last quarter at 1.03. Now, when we split this up into those three primary groups we tend to look at, subchapter S institutions, stock institutions, and that mutual, we can see each of the groups continued their upward trajectory throughout the third quarter, with the sub-S group at a 145, the stock bank groups at a 1.12, and the mutual institutions at 66 basis points. Across the board, each one higher, not only from the quarter prior in the second quarter, but also year over year posting positive returns. When we look at the net interest margin, this is where we've seen the biggest pickup with inside of that performance. Net interest margin getting up to 3.51% on average, or the median for the overall group, continuing its rebound from its low of just 3.07% back in the first quarter of 2022. This, of course, is made up between the yield on earning assets and cost of funds. Yield on earning assets skyrocketing to that 384 because of the increase in interest rates throughout this year, really putting upward momentum on that yield on earning assets. That's a huge positive and has been propping up the performance not only in the net interest margin, but also in the overall return on average assets. Cost of funds, however, we've seen it be very anemic throughout the past 12 months. And then this quarter, in the third quarter, we begin to pick up actually 11 basis points quarter over quarter. A pretty significant increase when you look at percentage-wise. That is going to continue to pick up. We've known that we're going to be lagging in terms of changing those deposit rates, and we expected that throughout the third quarter. Into the fourth quarter, though, I believe there's going to be a need to begin these increasing in these deposit rates more broadly, pushing up that cost of funds just because of that liquidity issue. And if we do start seeing deposits roll off of balance sheets at these community institutions, those increase in deposit rates are going to be needed in order to retain those funds. So we begin to see that in the third quarter. I think it's going to be more pronounced in the fourth quarter numbers. When we're looking at the balance sheet, we know throughout the pandemic we've had a pretty significant increase in or decline in the overall net loans and leases to assets. And we've started to see that rebound when we turned the quarter into 2022. At the end of the year 21, we're at 57.49% of assets in loans and leases. That went up to 59% in the second quarter 22, and now at 61.17% in the third quarter, just showing that increase in overall level of loans. However, we're still below where we were pre-pandemic at 66%. So we continue to have some way to grow there. Another item was that interest-bearing cash balances. We can see we are now at the third quarter at 6.71%. We're where we were back in pre-pandemic time periods of 6.81. So we're very similar. We've seen some of this cash kind of roll off either into the loan portfolio or into that investment portfolio. But overall, it's this quarterly cost of interest-bearing deposits that we're keeping our eye on. Because we can see as we look back to 2015, we saw this peak in this number back in the third quarter 2019 at 1.15. And then throughout the pandemic, that just continued to be reduced down to that low in the first quarter of 2021 at 35 basis points. Second quarter picked up to 37 basis points, and the third quarter picking up to 53 basis points. So we saw that increase pretty significantly between the second and third quarter of 2022. And we're going to see probably similar, if not higher, increases when we look at the fourth quarter numbers that will be coming out at the end of January. So that's going to be interesting to see that, but I anticipate that picking up, maybe even up to that 70 basis point level. Remember, throughout the past year, we've had an overall increase in those shorter term CDs, and now a lot of those shorter term CDs are coming in for renewal, and most likely they're going to be at substantially higher rates than where they are currently. So that's going to push up that overall quarterly interest cost of interest-bearing deposits. That'll be something we will keep an eye on. Overall, when we look state to state, the average cost of interest-bearing deposits, we can see the highest out here, actually in Rhode Island, at 86 basis points. And then we can look at the different numbers in the state to state, and you can compare your overall level of cost of interest-bearing deposits to these individual state averages. When we're looking at efficiency, net overhead did increase throughout the past couple of quarters. And remember, when we're looking at net overhead, the lower the number, the better. So we're up to 186. That, of course, is the difference between non-interest expense and non-interest income. But when we look at overall state-to-state averages for our measure of efficiency, that net overhead number, we can see that Pennsylvania here at almost 1.5% at 1.49. And we can see where that Rhode Island number is at 3.05. So this is a good estimation, a good way to compare yourself for the third quarter against your state's average. And we can get into a little more detail with these numbers if you just feel free to give us a call. When we were looking at those components, the non-interest expense, we saw increase quarter over quarter, while we saw the non-interest income decline slightly. So we had a 4 basis point increase in non-interest expense and a 2 basis point decline in non-interest income. So on both sides of that equation for those components, they both deteriorated. Neither one improved. So that kind of increased, and we expect in the fourth quarter that to happen again. But when we look at non-interest expense, the lion's share of this primarily will be those salaries and then the fixed cost of premises. So we look at where we are across the United States, Pennsylvania at 3.35. Look where we are at Rhode Island for non-interest expense at 3.96. So feel free to look at this compared to where your individual state average is. Of course, we have Nevada up here at 10.33, kind of an anomaly sticking out there. But this is going to be an issue because when we get into the new year and we start factoring in where are those raises going to be, if we look at the CPI, we know the overall level of not only just benefits, but the salary portion is going to most likely go up 5 to 7%, perhaps even 8%, depending on your local demographics. So we know there's going to be a fairly significant increase in the overall level of the salary and benefits component when we get into 2023. What about risk? Risk we've seen increase slightly. When we look quarter over quarter, up a little bit. It's hard to really tell on the chart, but we are getting closer or further into that moderate zone. When we look at the 4 individual components of that risk that are specific to the banking environment, you look at capital risk. Capital risk has increased, and we know a lot of that increase is due to the devaluation of those bond portfolios because of the run-up in interest rates. So we've had that increase. In fact, now in the third quarter, about a little more than 17% of institutions have an equity to asset ratio of less than 6%. And we had 19 institutions in this benchmark group that had negative equity to asset ratios. And they're negative solely because of that, the AOCI pulling that down. So when we look at the regulatory capital ratios, the leverage ratio, and the risk-based capital ratios, those are all maintaining their overall levels. But when we look at that gap equity, we see that impacted significantly. And if your institution is down below that 6% equity asset ratio, you should start to look at that credit quality inside your investment portfolio and making sure that that credit quality is not deteriorating and that the decline in the valuation is solely due to that interest rate mismatch. When we look at credit risk continues to remain fairly strong. We haven't seen that credit issue. So we hope that that continues to be the case. Liquidity risk starting to increase, getting into that moderate zone solely because of that lower level of deposit growth, and we start to see those cash balances roll off to fund those loans. So we start to see that liquidity risk picking up. Earnings at risk starting to come down with the net interest margin continuing to improve and the overall level of the volatility in that net interest margin, which is what we use when we measure earnings at risk. We're looking at that volatility of net interest margin over a 9-quarter period. And the greater the volatility compared to the overall average net interest margin inside that measurement period, that's when we see this higher level of overall earnings at risk. So we anticipate this number to begin or continue to come down. Well, that's what we have for you today. We look forward to talking to you once again next week when we take another look at where interest rates are and how they will impact the bank's profitability going forward. Have a great day, everyone.